Ladies and gentlemen, let me ask you a question. What if I told you that freedom is not about money? What if I told you confidence is not about talent? And what if happiness is not something you chase, but something you create? Today, we are not just talking about economics. We are talking about the economics of your life. The formula for freedom, confidence, and happiness is not written in textbooks. It is written in decisions. And the quality of your life is determined by the quality of those decisions. What if I told you that the most valuable asset in any economy is not oil, not gold, not technology, but you? In economic theory, nations grow when they invest in capital. But there is one form of capital that determines whether an individual rises or remains stuck: human capital. Human capital refers to the knowledge, skills, health, experience, and abilities that increase a person's productivity and earning potential. It is the invisible engine behind income growth, career mobility, and long-term financial independence. In economics, physical capital such as machinery and infrastructure increases output. Similarly, when you invest in education, professional training, technical expertise, and personal development, you increase your productive capacity. The labor market rewards specialization, innovation, and efficiency. Individuals who continuously upgrade their competencies shift from being easily replaceable to becoming highly valuable contributors, and value in a market economy determines compensation. The more rare and relevant your skills, the greater your bargaining power. Consider this: technology evolves, industries transform, and global competition intensifies. Those who fail to invest in their skills experience economic stagnation. Their income growth slows, their opportunities narrow, and their vulnerability to unemployment rises. On the other hand, individuals who treat learning as a long-term investment generate compounding returns. Every new skill enhances adaptability. Every certification strengthens credibility. Every experience increases strategic advantage. Over time, these incremental gains accumulate into exponential economic mobility. Human capital investment also reduces economic risk. A diversified skill set functions like a diversified investment portfolio. When one industry declines, adaptable individuals transition into emerging sectors. This flexibility enhances resilience during economic downturns and strengthens long-term income stability. In labor economics, employability is not a fixed trait. It is an evolving asset shaped by continuous learning and strategic positioning. Ask yourself, are you consuming information, or are you strategically acquiring assets in the form of skills? Because the marketplace does not pay for effort alone, it pays for value creation. Human capital determines your productivity. Productivity determines your income, and income determines your financial freedom. The most powerful economic strategy is not waiting for external opportunities, but becoming so skilled, so knowledgeable, and so capable that opportunities compete for you. Every decision you make is costing you something. The question is, do you know what it is? In economics, this concept is known as opportunity cost. The value of the next best alternative that is sacrificed when a choice is made. It is invisible, yet it shapes careers, wealth, productivity, and ultimately, the quality of life. You may think a decision is free because no money leaves your pocket, but economics teaches us that nothing is truly free. Time, energy, capital, and attention are scarce resources, and scarcity forces choice. Imagine spending 3 hours scrolling through social media. The monetary cost may be zero, but the opportunity cost could be studying a new skill, building a business idea, networking, or improving your health. The real economic impact lies not in what you chose, but in what you gave up. Individuals who understand opportunity cost develop sharper decision-making frameworks. They evaluate alternatives, measure potential returns, and allocate resources toward activities with the highest marginal benefit. In financial decision-making, opportunity cost becomes even more critical. Choosing to spend rather than invest means sacrificing potential compound growth. Delaying skill development may result in foregone income increases. Accepting short-term comfort might mean surrendering long-term advancement. Economic success is rarely about making perfect decisions. It is about consistently choosing options that generate higher future value over immediate gratification. Opportunity cost also applies to businesses and governments. Capital allocated to one project cannot be used elsewhere. Efficient economies grow because resources are directed towards sectors that maximize productivity. Likewise, individuals grow when they intentionally direct time and money toward high-return activities, such as education, professional networking, and health improvement. When choices are aligned with long-term goals, opportunity costs become strategic investments rather than unconscious losses. Here's the powerful shift. Instead of asking, "What will this give me now?" ask, "What might this prevent me from gaining later?" That single question transforms impulsive behavior into economic reasoning. Rational decision makers think at the margin. They compare incremental costs with incremental benefits and prioritize actions that enhance future earning potential, stability, and fulfillment. The difference between stagnation and growth often lies in the awareness of trade-offs. High performers are not necessarily smarter. They are more selective. They guard their time as capital. They treat focus as currency. They understand that every yes to one option is a no to another. Mastering opportunity cost is mastering strategic life allocation. What if financial stress is not caused by lack of income, but by misallocation? In economics, the difference between prosperity and poverty often lies not in the amount of resources available, but in how efficiently those resources are allocated. The same principle applies to individuals. Income alone does not create freedom. Strategic allocation does. Two people can earn the same salary, yet one builds wealth while the other remains trapped in financial pressure. The deciding factor is efficiency in managing scarce resources. Every individual operates within constraints: limited time, limited income, limited energy. Economic theory teaches that rational agents maximize utility by distributing resources toward their highest value uses. In personal finance, this means prioritizing essential expenses, controlling discretionary spending, building savings, and investing for long-term returns. When consumption consistently exceeds production, dependency grows. When allocation is disciplined and intentional, autonomy increases. Budgeting is not restriction. It is optimization. It is the deliberate assignment of financial capital toward categories that generate stability and future opportunity. Savings function as liquidity reserves, protecting against unexpected shocks, such as medical emergencies or job disruptions. Investment channels, surplus capital into productive assets. Stocks, businesses, real estate, that generate returns over time. This shift from consumption-driven behavior to investment-driven behavior transforms income into wealth-building machinery. Efficient allocation also extends beyond money. Time allocation determines productivity. Individuals who dedicate focused hours to skill development, strategic planning, and high-impact tasks increase their long-term earning potential. Energy allocation influences performance. Directing mental and emotional resources toward constructive goals enhances output and professional reputation. Inefficiency, whether financial or behavioral, creates leakage, small, repeated losses that compound into significant setbacks. Economic systems thrive when resources flow towards sectors with the highest marginal productivity. Similarly, personal financial systems thrive when expenditures align with long-term objectives rather than short-term impulses. Delayed gratification is not merely psychological discipline. It is economic foresight. Allocating funds toward appreciating assets rather than depreciating liabilities increases net worth over time. Consider this. Financial freedom is rarely the result of sudden income spikes. It is the outcome of consistent, efficient decisions. When individuals track expenses, eliminate unnecessary debt, negotiate costs, and prioritize investments, they strengthen their financial structure. Efficiency reduces vulnerability, increases flexibility, and creates options. In economic terms, options represent power. The ability to choose employment, location, or lifestyle without financial coercion stems directly from disciplined allocation. The marketplace rewards those who manage resources with precision and foresight. What if the smallest decision you make today could multiply your success tenfold in the future? In economics, one of the most powerful forces shaping wealth creation is the principle of compounding growth. Compounding occurs when returns generate additional returns over time, creating exponential expansion rather than linear progress. It is subtle at first, almost invisible, but over the long term, it becomes unstoppable. This principle does not apply only to financial capital. It governs skills, productivity, reputation, and opportunity. In finance, compound interest allows invested capital to grow at an accelerating rate because earnings are reinvested. The same dynamic operates in human performance. When individuals consistently improve their knowledge, refine their abilities, and apply disciplined habits, they create cumulative advantages. A 1% improvement in productivity each day may appear insignificant, yet over months and years, it transforms professional capability and earning potential. Marginal gains accumulate into competitive dominance. Economic growth models emphasize reinvestment as the engine of expansion. Profits reinvested into innovation, infrastructure, and workforce development generate higher future output. Likewise, individuals who reinvest time and income into education, certifications, strategic networking, and health increase their long-term productivity. Skills build upon previous skills. Experience enhances judgment. Confidence strengthens decision-making efficiency. These layered effects create upward momentum. The compounding principle also highlights the cost of delay. Postponing investment, whether financial or intellectual, reduces the time horizon available for exponential growth. Early action maximizes cumulative returns, while procrastination diminishes potential output. This is why disciplined saving and continuous learning outperform sporadic effort. Consistency matters more than intensity. Repetition strengthens competence, and competence increases value in the labor market. Technological innovation provides a clear example. Companies that consistently invest in research and development often experience accelerating growth as knowledge compounds. Individuals who remain adaptable and continuously update their expertise similarly benefit from expanding career opportunities. Compounding rewards patience and punishes inconsistency. Imagine directing daily effort toward high-value activities that reinforce each other over time. Reading enhances insight. Insight improves decisions. Better decisions increase income. Increased income funds further investment. This reinforcing cycle creates exponential advancement. Growth, when strategically compounded, transforms modest beginnings into substantial achievements. The mathematics of progress favors those who understand that sustained incremental improvement outperforms occasional dramatic change. Why do some individuals accelerate ahead while others remain paralyzed at the starting line? The difference often lies in their understanding of risk and return in economics and finance. Risk is not something to be avoided entirely. It is something to be evaluated, priced, and managed. Every potential return carries a level of uncertainty. Higher expected returns typically require greater exposure to variability. The objective is not reckless risk-taking, but strategic risk assessment. Consider investment markets. Conservative assets, such as government bonds, offer lower but more stable returns. Equities and entrepreneurial ventures, while more volatile, offer higher long-term growth potential. Rational investors diversify portfolios to balance exposure, optimizing expected return relative to risk tolerance. Individuals operate under the same principle in their careers and financial decisions. Avoiding all risk may preserve short-term stability but often limits upward mobility. Conversely, unmanaged risk can produce significant loss. Strategic growth lies between fear and recklessness. Professional advancement frequently requires stepping beyond comfort zones. Pursuing advanced education, relocating for opportunity, launching a venture, or accepting leadership responsibility. Each action involves uncertainty. Yet calculated risk, supported by research, preparation, and skill development, increases the probability of favorable outcomes. The labor market rewards those who demonstrate initiative and adaptability. Economic history shows that innovation emerges from those willing to confront uncertainty with informed action. Risk management also involves information acquisition. Asymmetric information increases vulnerability, while informed decision-making reduces uncertainty. Conducting due diligence before investing, analyzing market trends, understanding industry dynamics, and assessing personal financial capacity are all components of rational risk evaluation. Confidence is strengthened not by ignoring risk, but by understanding it. There is also opportunity risk, the danger of inaction. Failing to invest, delaying skill acquisition, or avoiding entrepreneurial efforts may appear safe, but these choices carry hidden long-term costs. Inflation erodes idle savings. Technological change reduces the relevance of outdated skills. Competitive markets reward innovation and penalize stagnation. Effective economic actors measure potential downside against expected upside. They build contingency plans, maintain liquidity reserves, and diversify income streams. This approach transforms uncertainty into manageable exposure. When risk is analyzed, structured, and aligned with long-term objectives, it becomes a catalyst for advancement rather than a source of fear. Economic growth, whether personal or national, has always been driven by those willing to engage uncertainty with preparation and strategic intent. What determines income in a market economy? Effort alone? Hours worked? Or something far more powerful? The marketplace rewards one thing above all else: value creation. In economic systems, compensation is directly linked to the ability to solve problems, meet demand, and improve efficiency. The greater the value delivered to others, the greater the return received. This is not philosophy. It is market logic. Think about the highest paid professionals and most successful enterprises. They do not earn more because they work harder in terms of physical effort. They earn more because they create solutions that impact larger numbers of people or address more complex needs. Value is determined by utility and scarcity. When an individual develops specialized expertise that is both rare and in demand, their market price rises. The forces of supply and demand operate continuously, adjusting compensation based on contribution. Ask yourself a powerful question. Whose problems are you solving? Income expands in proportion to the scale and significance of the problems addressed. A local service generates limited economic impact, while scalable innovation generates exponential returns. This principle explains why technology platforms, financial strategists, medical specialists, and skilled entrepreneurs command higher earnings. They create measurable economic value that improves productivity, reduces costs, or enhances quality of life. Value creation is not limited to financial gain. It also generates intrinsic satisfaction. Behavioral economics suggests that individuals derive fulfillment from meaningful contribution. When work aligns with service and impact, motivation increases and performance improves. This creates a reinforcing cycle. Higher value leads to greater income enables further investment, and further investment enhances capacity to create even more value. Market economies operate on voluntary exchange. Consumers exchange money for goods and services that they perceive as beneficial. Therefore, the key to sustainable financial success is understanding demand, researching market gaps, identifying inefficiencies, and developing competencies that address unmet needs position individuals competitively. Adaptability also plays a crucial role. As consumer preferences and technologies evolve, value must evolve accordingly. Economic influence grows with leverage. Leveraging technology, networks, and capital allows one person's effort to impact many. When contribution scales, income scales. The marketplace consistently rewards those who focus less on earning and more on serving effectively, efficiently, and strategically. So today I challenge you. Decide what freedom means to you. Decide what skills you will master. Decide who you will serve. Because the moment you decide, your life shifts. Remember this, it is not resources that create success. It is resourcefulness. And resourcefulness is a decision. Stand up in your life, take control of your economics, invest in your mind, act with certainty, grow daily, give massively, and when you do, freedom will not be a dream. Confidence will not be a struggle. Happiness will not be temporary. It will be your standard. Thank you. Now go out and create an extraordinary life.